I am Zinati Guma. Welcome to Business Day TV's post-budget analysis to break down Finance Minister Enoch Godongwana's revised master plan for navigating the economy's financial tightrope. And joining me with their assessment of what has been tabled in studio is Ricardo Smith, Chief Investment Officer at ABSA Investments. Of course, we will be having the perspective of the immediate reaction, business perspective, also getting some reactions from a tax professional and also from the political sphere. Well, thank you so much for joining us in studio, Ricardo. I was actually looking at the markets ahead of the budget, particularly the rand, and also during the budget. We did have actually the rand below 17 rand 90 against the US dollar, now just over that, but really remaining stable. And really, I know that the financial markets are always looking for stability, confidence, and certainty. Is this what they got in this budget, considering the reaction that I saw in the local unit?
Yeah, thanks. I mean, it's been a bit of a tough process. The contentious VAT increases aren't in there.
Yeah.
So one would expect this budget to pass in its current state given that removal.
Yeah.
There are some cuts in spending around some social grants and increases. Also removal of the COVID relief initiatives starting in the next fiscal year. So there could be some people unhappy with that.
Yes.
But overall, the big contentious issues aren't there. The one thing is that we are seeing debt increase. So debt to GDP now expected to stabilize at about 77%. They still say they're committed to their consolidation path. They haven't pushed forward the period of containing that debt, but it does stay quite elevated over the next 3 years. Compared to what the previous budget was tabled, and we are seeing the deficit widen a bit, in particular in the next fiscal year.
You talk about the increase of that debt to GDP ratio. Is this anything to worry about, or is this also a reflection of the lower forecast for growth that we did get?
Yeah, I mean, there aren't a lot of levers to pull. There is lower growth, and then you remove the two VAT increases. The initial one was projected to bring about 190 odd billion. The two 0.5 percentage points increases would have brought in about 75 odd billion. So you either issue more debt. The other option that they did have was tapping into the GFRECA account, which is currently sitting with a surplus of about 90 odd billion.
I actually thought they'd go for that.
Yeah, the challenge with that is gold prices have been quite strong, and so it is quite sensitive to gold prices. So if we see gold prices pull back from a surplus, you could find yourself in a tricky position. And of course, the rand itself, in recent weeks, it's been strengthening against the dollar, or rather the dollar has been weakening against most currencies. And if that continues, then you find yourself in a bit of a problem. So you don't want to continuously tap into that GFRECA account, particularly given that volatility. But it was an option on the table. All things considered, it was not a bad budget. Yeah.
All right. The current economic landscape is looking grimmer than thought, particularly for this year. But of course, the budget is also it's also there to really clear a path for what to look forward to in the future. Did it then speak to a higher level of economic growth going forward? I did hear he said that there's been a shift from spending on consumption to investment. Did we get that tone?
Yeah, so a lot of the development initiatives were largely protected. A lot of the cuts came from social grants and the likes. Economic development expected to increase allocation by 8.2 odd percent annualized over the next 3 years. There's still roughly that 1 trillion, although there is some details lacking on infrastructure spend, be it transport, logistics, water infrastructure, as well as energy. So a lot of the developmental initiatives largely protected. We think one risk remains the wage bill. It is always a conversation between government, and the labor unions, as well as government employees. Another risk continues to be struggling state-owned enterprises. They are looking to make them a bit more efficient. Now, efficiency is not something you achieve in the budget itself, right? It is the responsibility of government overall, and the finance minister can't necessarily excuse himself from that because he is part of government. But you know, the proof will be in the pudding to whether they can actually make them a bit more efficient.
All right. So ahead of this budget, we did have S&P Global coming in with their credit rating review of South Africa, affirming our current credit rating and also keeping the outlook as positive, seeming that they're really unbothered, kind of expecting what we heard today in the budget. Considering what was tabled today, I was thinking maybe in the next review that could clear a path to a ratings upgrade. What do you think of what the ratings agency, how they're looking at this budget?
Yeah, look, I don't expect a ratings upgrade in the near term, particularly given that debt to GDP projections have slipped a bit. If we stick to the path and potentially get some positive surprises, you know, in particular the fact that we haven't pushed forward the period of containment, I think that will be seen as a positive. But I don't believe at this point it's enough for an upgrade.
Right. Well, we do have to wrap up our conversation. Thank you so much for your time and really giving us insights on the immediate reactions to the budget, and particularly the impact on the financial markets. That was Ricardo Smith, Chief Investment Officer at ABSA Investments.